In the real estate industry, it's been commonly accepted that a balanced housing market contains about 6 months of inventory. This means that the total number of sales for a given month should equal one-sixth of the total number of listed properties, resulting in a 6 month period to clear that inventory. Even the National Association of Realtors has stated that historically 6 months of supply is associated with moderate price appreciation. However, the current housing market has seen a decline in prices despite it being a seller's market in theory. In May of 2023, housing prices were down 2.2% nationally from their peak in June of 22. Meanwhile, inventory sat at only 3 months in the May of 2023, which is really half of what is considered a balanced market. Gauging this market is tough, admittedly, and this market is peculiar, and it may explain why prices are falling despite being a seller's market, given the amount of available inventory. Prior to the rate hikes last year, prices were rising at an unprecedented rate, and these rate hikes made it much more expensive to buy a home for anyone using debt, which again put downward pressure on prices. However, as the vast majority of homeowners have low interest rate, fixed rate mortgages, there's really little motivation to sell. Thus, while there are a few buyers at these prices with these rates, new listings are down sharply and keep supply low, which are buoying the home prices. Even in nominal terms, prices have fallen, and in real terms, when taking inflation into account, they've fallen by about 10%. This implies that our idea of a balanced market needs to be adjusted. Part of the problem may be that the average supply of inventory for new home sales has historically been around 6 months, if not more. When it comes to evaluating the housing market, existing home sales are a better indicator than new home sales. For example, in March of 2023, the annualized rate of existing home sales was 4.43 million, while the annualized rate of new home sales was only 683,000. And if anything, the gap between the two is normally larger. This strongly suggests that our concept of a balanced market is a month or so higher than it should be. Another problem is that prices and inventory are not as correlated as we would expect. During the financial crisis, median home prices peaked in quarter one of 2007 and then hit their trough in Q1 of 2009, before rising almost without interruption afterwards. Yet inventory levels did not fall below 6 months until 2012. Just like any other market, there are too many factors involved in the housing market to rely on a single rule of thumb. However, it should be evident that a balanced market is probably closer to 4 or at most 5 months of inventory than the standard designation of 6 months. Moreover, the number of months of inventory is of limited value when it comes to understanding prices. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281 222 0433. Hope you have a good day.